Crisis never arrives quietly. It simmers, accumulates, and waits, hidden beneath the surface. The 2008 financial meltdown felt sudden, yet it was years in the making. Complex derivatives, excessive leverage, and globalized debt quietly built pressure until the system could no longer contain it. Today, history is whispering again. The blueprint for the next crisis already exists, hidden in plain sight. It begins with debt. Sovereign, corporate, and household obligations have reached unprecedented heights. Borrowing fuels growth, inflates asset prices, and creates the illusion of stability. But high debt is not inherently dangerous. Danger comes when growth slows, rates rise, or confidence falters. Next comes liquidity. It appears everywhere, but it is fragile. Stock markets, ETFs, corporate bonds, and private markets all rely on continuous funding. Sell-offs are manageable only as long as buyers exist. Withdraw confidence and liquidity evaporates in seconds. Markets freeze. Panic spreads. Then comes leverage. Investors borrow to amplify returns. Hedge funds, banks, and corporations all depend on leverage to achieve growth in a low-rate environment. Leverage magnifies profits and losses. Even a small shock can cascade through the system. The interplay of debt, liquidity, and leverage is the foundation of every financial crisis. Yet, modern markets have added a dangerous new layer: central bank dependence. Central banks have become the ultimate backstop. They signal support. They intervene with liquidity injections. They suppress volatility. And in doing so, they create moral hazard. Markets take bigger risks because they assume they will be rescued. This is the paradox of stability. The more intervention stabilizes markets, the more fragile the system becomes underneath. Confidence is maintained artificially, and risks accumulate unseen. Technology has accelerated this process. High-frequency trading can amplify swings within milliseconds. Automated algorithms withdraw liquidity instantly during stress. Shadow banking operates outside standard regulations. Private credit markets hide risk from public view. Global capital flows create connections no one fully understands. In other words, crises no longer originate from a single market or sector. They propagate globally. A shock in one country instantly affects others. A default in an emerging market can ripple through sophisticated derivative structures. A sudden rate hike in one economy can trigger currency crises halfway across the globe. The next crisis will not come from where most expect. It will not arrive solely from housing, oil, or stocks. It will emerge from a combination of vulnerabilities, a systemic convergence of debt, liquidity, leverage, and dependency on policy. Consider the warning signs. Asset prices inflated far above historical valuations. Corporate debt reaching record levels. Governments relying on perpetual low interest rates. Market structures dependent on constant liquidity injections. Financial innovation masking risk in complex instruments. Global interconnections amplifying shocks. The blueprint is clear. Step 1. Over-leveraged markets. Investors borrow heavily, often assuming rates remain low, and liquidity flows endlessly. Risk is underestimated. Vulnerabilities accumulate. Step 2. An external shock. It could be a geopolitical conflict, a pandemic, a commodity price spike, or a sudden liquidity shortage. The system reacts not just to the shock, but to accumulated vulnerabilities. Step 3. Panic spreads. Confidence collapses. Credit markets freeze. Asset prices plunge. Margin calls force selling. Leverage multiplies losses. Markets that appeared stable moments ago become chaotic. Step 4. Central banks intervene. Rates are cut, balance sheets expand, liquidity is injected. Markets stabilize temporarily. The public perceives control has returned, but the underlying vulnerabilities remain, often larger than before. Step 5. Regulatory and political response. Governments may bail out key institutions, restructure debt, or implement new policies. These actions stabilize the immediate system, but often defer the problem rather than solve it. And when the dust settles, the cycle begins anew at higher levels of debt, higher leverage, and deeper market complexity. History has a rhythm. Financial crises rarely repeat exactly, but patterns persist. They always emerge where risk has accumulated unseen, amplified by confidence, leverage, and dependence. The blueprint of the next crisis is not a mystery. It is written in plain sight. Debt continues to grow. Liquidity is maintained artificially. Leverage amplifies positions. Confidence is sustained through intervention. The question is not if, it is when, and how large the fallout will be. What can we learn from this blueprint? First, no market is immune. Globalization has created interdependence. A shock in one corner of the world travels quickly. Second, stability can be deceptive. Markets may appear calm, while risk accumulates in hidden layers. Understanding structures matters more than predicting events. Knowledge of debt, liquidity, leverage, and central bank influence allows one to see the system's fragility before panic strikes. History is our guide. Every major financial collapse followed a similar pattern. Optimism, accumulation of risk, fragile structures, and sudden loss of confidence. Preparation is critical. Investors, policymakers, and citizens who understand the system's vulnerabilities can navigate turbulence more safely. Those who ignore them will be caught unprepared. The next crisis is not a story of malice or incompetence. It is a story of complexity, human behavior, and the invisible forces shaping global finance. It is the natural consequence of debt, liquidity, leverage, and dependence. It is the next chapter in the financial saga, a blueprint written in history waiting to unfold. Welcome to Cash and Chronicles, where money, power, and history collide.